Okay, good afternoon, good morning, everyone. Welcome to this webinar series entitled The World Economic Transform. This is a series that the Reinventing Bretton Woods started during the IMF and the World Bank Spring meeting last April with the support of Accenture. Thanks here, colleagues from Accenture, for providing support at a time that was difficult for us, reinventing Bretton Woods, because we used to meet face to face. And I hope that this initiative will provide us what we have been doing for many years, really to strengthen international cooperations. Today we have an outstanding group of speakers that will be moderated by Jacob FRENKEL. Jacob is the chairman of the board of trustees of the group of 30, the former governor of the Bank of Israel, and the former chairman of JP Morgan Chase International. He will be moderated to the sessions that will bring together President Robert KAPLAN. Robert KAPLAN is the president of the Federal Reserve Bank of Dallas. Mr. Yves MERSCH is a member of the executive board of the European Central Bank and the vice chair of the Supervisory board of the ECB. And last but not least, Mr. Klaas, the governor of the Dutch Central Bank, but also the vice chair of the Financial Stability Board. We met today yesterday, the IMF released, I think, grimmer forecast for the global economy. The global economy now will shrink by almost 4.9%, a downward from 1.9% from last April. Advanced country will be expected to shrink by 8%, and the emerging market will shrink by 3%. This is a context, and I'm pretty sure that our speaker will comment on the last IMF World Economic Outlook. But let me thank all of you for accepting these digital conversations. We have an outstanding group of participants also will be joining us. And now, last but not least, I give the floor for Jacob. And Jacob, again, thanks so much for accepting to moderate that conversation. Up to you. Thank you.
Thank you very much, Mark. And I join you in welcoming everyone to this Reinventing Bretton Woods webinar. I must say you are very modest, but you have been single-handedly able to carry the torch for so many years, and we appreciate it very much.
Thank you.
The group of central bankers that we have today is so experienced. They have seen growth, they have seen recessions, they have seen crises, they have seen challenges. And I think that drawing on their experience, it would be very useful if we devote this hour to understanding of where we are, where we go, what do we need to do in order to go to where we need to go. One of the points, and you mentioned, Mark, that yesterday the IMF has published its revised forecast, and one of the themes that they made was that this is not what the typical crisis is, and therefore the recovery will not be what the typical recovery has been. Well, I just want to remind you, this is that description also characterized the previous round, where we said nothing is the same, we have a new reality. So I think that it reflects the fact that using the old textbooks cannot be enough, but by the same token, throwing away the old textbook can be a disaster. There is one second point that I want to highlight about this IMF forecast, because this is unique this time. Each and every one of the countries in the forecast made yesterday, June 2020, has now a lower projection from the forecast made just 2 months ago in April. In April, we were already in the midst of the pandemic. And yet, the forecasts, which were viewed then to be gloomy, had to be revised dramatically downward. And in fact, the 4.9 negative growth that is now projected to the world economy was just 3.0 negative growth 2 months ago. And the same is true for each and every major country in the world. And I think this tells us, first, that the nature of the pandemic is very different. Second, that the dispersion of it is affecting the global assessment, that it is global, that uncertainty is huge, that the lockdown has had profound effects, that the scale and scope that policymakers have now to deal with is bigger than before, and therefore maybe we will also raise the theme that policy is not a free good. And occasionally, as you are trying to deal with a current problem, you may create a secondary one down the road. So with this in mind, let me approach first our friend Klaas, the governor of the Central Bank of the Netherlands, currently vice chair of the Financial Stability Board, designated to be the chairman next year. So you have several hats, and all of them, please highlight maybe the European perspective so we can later on go to other continents. Please, Klaas. And we have, each one will have between 4 to 5 minutes for the opening remarks. Please.
Well, thank you, Jacob. That's quite ambitious, I would say. But nonetheless, what I wanted to do in my opening remarks is spend a bit of time on sort of the outlook for the euro area, the recovery phase, and then with a particular emphasis on the policy mix that I believe would be best in the recovery phase, where I think we can also learn some lessons from the previous recovery. So if you look at all incoming information, it's pretty clear the global economy has been hit quite hard by this corona crisis. In case of the euro area, earlier this month, we published new projections anticipating an 8.7% drop in GDP euro area for 2020. And this was also clearly subject to downside risks, as it left open the possibility of more severe scenarios in case of strong resurgence of the spread of the virus. Now, it is clear that the policy response observed thus far in the crisis phase has been crucial to avert even worse outcomes for now. On the monetary, fiscal, and prudential policy side, authorities have stepped in forcefully to help the economy establish a foothold as it went into lockdown. The gradual reopening in recent weeks has reconfirmed that we have moved past the impact phase of the shock now. This moment gives us a first glimmer of an incipient recovery that will now have to take shape. And this is actually confirmed by several recent indicators. Confidence indicators for the euro area in June released this week, showing a strong rebound to close otherwise disastrous second quarter. Forward-looking confidence indicators already showed that bottoming out took place early in May, and several high-frequency indicators show that the mobility, the payments, mobile payments, etc., started to recover from mid-April onwards, albeit very gradually. So I would say that the recent data solidifies the confidence in our baseline scenario and should therefore also allow us to gradually move away from even more severe scenarios. Yet even in that baseline scenario, economic activity will only approach the pre-corona 2019 level by the end of our projection horizon at the end of 2022. And looking ahead at the recovery, it is clear that ample policy support to the economy will remain important for an extended period of time. At the same time, and we should also be mindful that as the outlook unfolds, we will learn more about the underlying impact of the shock to the economy. And that will be relevant for assessing the appropriate design of the policy response. So let me highlight two elements here. First, the extent to which the impact on the economy will materialize as a demand versus a supply shock, and that is still largely unknown. While we are fairly confident that in the near term, increased uncertainty implies a strong withdrawal of aggregate demand, in the medium to longer run, negative supply effects can very well gain in relevance as businesses adjust their production processes to the new environment. And since the latter would be associated with upward price pressures, they impact also on the intensity with which monetary policy can continue to support the economy. In addition, temporary crisis measures may lose some traction in terms of necessity and effectiveness when the economy moves along a more stable trajectory. Second, the observed increase in private sector savings as a consequence of crisis-induced uncertainty provides a strong rationale and in fact also leeway for the public sector to increase spending to lean against the increased propensity to save. Over a longer horizon, dissipating uncertainty will then invoke a resumption of private sector activity, for which the public sector might then have to retreat in order to avoid crowding out effects. So the pace at which uncertainty dissipates will have an important implication for the pace at which fiscal support can be withdrawn. And simultaneously, we have learned that there are actually benefits of ensuring that fiscal policy moves consistently with monetary policy. All this implies that the policy mix will have to be adjusted in terms of composition based on the evolving assessment of the broader underlying state of the economy. And a broad and encompassing policy mix that is adjustable in composition is important to ensure that we don't rely overly on individual measures that could be subject to unintended side effects if they are in place for too long. In the previous recovery from the euro area debt crisis, relying too heavily on monetary policy to get the job done has contributed to perceptions of a central bank put, which has then fed into global concerns about ratcheting up of debt levels and excessive leverage. Such concerns have recently become manifest, for instance, in the corporate sector. Hence, an important element was actually missing in that recovery. Monetary policy successfully eliminated slack in the economy, most importantly in the labor market. But a convincing resumption of sustainable productive investment failed to take hold. And this turned out to be a main factor why a real income convergence in the euro area stagnated during the last decade. And against this backdrop, I have also welcomed the recent proposals to arrive at the European Recovery Fund. This initiative foresees investment in the EU's important policy priorities, specifically its Green Deal and its digitalization agenda. And also, I would like to emphasize in those parts of the euro area where public investment has been depressed for quite some time. Moreover, in these times of exceptional uncertainty, in my view, it would also provide an important signal that we do not stop short at only stabilizing our economies, but that we also take the opportunity to address common longer-term challenges, thereby solidifying the recovery to take root. So let me stop here, Jacob, and continue later on.
Thank you. Thank you very much. After the opening remarks of the panelists, we may engage in Q&A, and some participants may plug in their questions using the screen that is in front of you. We are now turning to Mr. Yves MERSCH, who is, as was indicated, a member of the Executive Board of the European Central Bank and Vice Chairman of the Supervisory Board of the ECB. Very experienced central banker. Please take your opening remark. The floor is yours. Thank you.
Thank you, Jacob. I, of course, will now have to be very careful not to have any nuance with my friend Klaas, but let me start what has also been quite different this time around, and that is in the past in the euro area, the markets were used to have only one game in town, and that was the central bank game. And this time around, the reaction function vis-à-vis an incoming crisis was much more broad in all policy areas. And it was not only monetary policy, it was also the microprudential supervision, it was the macroprudential supervision, which in the European context is still a national competence, while the microprudential is largely a centralized competence. It has been also at the national level, the fiscal side that has been strongly responding with moratorium and guarantees. And it has been at the European level also the first time that we tried to come together, and we are still discussing the fiscal response for the recovery this time around. So we reacted much more than a proper unified nation state for the first time over the last 20 years that I have been seeing the European responses in this respect. But let me say a word about what the ECB done. Of course, monetary policy has the advantage of being the fastest reaction function, because it addresses first and foremost the vanishing of liquidity. And therefore, what we try to do is immediately to take measures to maintain market functioning, and thereby also to make sure that our accommodative monetary policy stance would continue to be properly transmitted into the different components of our monetary union. And thereby, we also, I think, contributed to cushion the drop in activity and to prevent an excessive seizure in the markets. And I would say it was also what I perceived as a coordinated global reaction in this respect that also helped to avoid a downward spiral in financial markets and thereby to dispel tail risks. All in all, for central banks, price stability in the euro area remains to be the focus of our policy measures. But for the moment, in order to pursue price stability, we have to focus all our efforts in a recovery, support the recovery. After we have successfully, I think, managed to avoid major market seizures and to maintain the market function. It remains that our existing, as has been said, macroeconomic models, which are based on past experiences, are not fully taking account of the specificities of such a pandemic crisis and sometimes do not react properly to the extent of the downfall and also the recovery of such a pandemic. And that goes not only for our central bank models, I would say we see it also in discussion in the supervisory side with banks, with their internal models, which also do not always give the appropriate results. But in any case, we are faced from that point of view with an enormous amount of uncertainty. Therefore, one essential element of our measures was that we would need the appropriate flexibility to be able to react short term, to recalibrate both the intensity of our measures, the depth of our measures, the direction of our measures. And that is what we did mainly through our main intervention instrument that was a newly created pandemic emergency purchase program, which was designed for and foremost to act as a backstop. And therefore also to have the necessary flexibility across not only jurisdictions in the flows of purchases, but also across asset classes. And we have moved from some asset classes to other asset classes to focus mainly on, but also over time. So this flexibility is inherent. But this flexibility also has a counterpart. It means that we lowered our risk protection, but we also lowered the guarantees that we have inbuilt, constitutionally inbuilt, to prevent us from crossing the constitutional red lines that we have in the European Union, especially when it comes to monetary finance. But counterparty of this increased flexibility is that this program will obviously have to be temporary. And as soon as we will see that the consequences of this pandemic crisis will vanish, we will also see whether we will have to use the full envelope that we have been given or whether we can lower the intensity. Let me say a last word about the economic impact of the crisis. True, it has been a very sharp impact, but we know that the trough is behind us. And even if we have now received what some perceive as very pessimistic projections from the IMF, which might also not have fully factored in some of the mitigating factors responses that this time around has been much stronger. It is a very heavy impact, and we are now focusing on the recovery. And with all the accompanying alphabetic soup that we see from V to L to U and so on. But I think that will be crucial. And it is, as Klaas already said, this recovery, which is so uncertain at the moment, depends in particular on the extent to which the effects of the crisis will exert prolonged and lasting pressure on supply and on demand conditions, and on the strength and the speed of the fiscal and structural response. Let me just add 2 words in this conference. I think what is very important is we have seen a certain fragmenting of world trade. And I think some of this fragmenting will be there to stay. And for example, it will redirect the focus of supply chains, which henceforth have been more focused on short-term price efficiency, and they will probably move over the medium term more to increased resilience considerations. This will lead to a redirection of the outsourcing, or there might be some onshoring again of supply chains, and there will be a reshoring also of production. But at the same time, we might also see a surge in corporate indebtedness that could make firms riskier, and it will continue to weigh on their capacity for investment. Together with labor underutilization, these combined effects could act as a brake on productivity growth. And that can, to my effect, only be effectively offset if both firms and policymakers use this crisis as a catharsis to modernize our economies, and this goes above all in modernizing in the direction of digital transformation, refocusing supply chains in order to fully exploit the allocative efficiency that we have, for example, in the euro area with the single market, and which could be further exploited. And such reforms would be crucial to smooth the sectoral reallocation which could result from the damage that even mild distancing measures inflict on labor-intensive service sector. While a counter-cyclical fiscal push can certainly help sustain aggregate demand in the transition, just as Klaas has also mentioned it, I think fiscal space might not be available everywhere to the same extent, as the initial conditions of the different economies also diverge. Therefore, we should use every policymaker to use the current window of opportunity and, in my opinion, create levers at the European level to reduce the risk of individual countries emerging from this crisis excessively scarred. Therefore, the European Commission's proposal for a major recovery plan that not only due to its size, but also to the way it will be funded, which will be something new for Europe to include joint issuance, is to be seen as a major step of reinforcing our monetary union and to reinforce also the resilience of our union. Let me stop here.
Thank you very much, Yves. As expected, clear and far-sighted. It means, but as I listened to both of you, there was one common theme, which is it's not just monetary policy. In fact, this time we need to talk about a broader policy mix. Second, we should get out as soon as we can from the mode of the crisis per se into a mode of recovery, and which, if we have recovery mode, it automatically we must think about the longer term rather than just the shorter term. Let me cross the ocean now, and the ocean may be in some areas very shallow, but in some others very deep. And I know that those of us who listened to President Robert Kaplan so frequently in the past few weeks on television, the last thing that one can say about him is that he's speaking central banking jargon. He's straight to the point. He doesn't leave you asking what did you really mean. So with this in mind, of course, you have had in the US a little bit of a mania depressia. From time to time, suddenly there is good employment data, good retail data, bad virus data. Take the floor, please.
All right, thank you, Jacob, and thank you, Klaus and Yves. Let me quickly just recap economically what's going on in the United States, and I'm going to talk about the policy response and 3 or 4 of the big challenges we're facing at this stage. Like Yves and Klaus, we've had a significant contraction in the second quarter in the United States. That's not a surprise. We've been talking about it. We think that the U.S. economy, when it's all said and done, will contract on an annualized basis 35 to 40% in the second quarter of this year. Again, that's annualized. It had been our view, based on employment data, looking at credit card data, other high frequency data, that the economy was bottoming out, or bottomed out to some extent during the early part of May. And it's been our view that, that the US economy is beginning to recover, with a big caveat, which I'll come back to in a moment, which is the advance of the virus. And it had been our view that we would have strong growth in the third quarter and the fourth quarter this year, but we would still end the year with a contraction in the United States in the neighborhood of 5%. And by the way, that estimate is more aggressive than some of my colleagues. And we would end the year with an unemployment rate certainly elevated and very likely well in excess of 8%, and maybe in the range of 8 to 10% at the end of this year. And we would have to spend 2021 trying to grind down that level of unemployment. In order to address this situation, there have been 3 aspects in my mind to policy. One is fiscal policy, which unemployment benefits and other grants that help people that are unemployed particularly sustain through this period. There's the 13-3 programs that the Treasury and the Fed have done in conjunction with each other. And these are a whole range of programs that have been intended to help stabilize market function, whether that's the money market funds, municipal bond markets, corporate bond markets, lending programs to small businesses, which I would include, we've referred to as the payroll protection program here, which was intended to get loans to small business, which could be converted to grants based on how many employees were kept. We've had a whole range of programs in addition to buying treasuries and mortgage-backed securities and lowering the Fed funds rate. What we're finding, and what I believe at this stage, how we do from here and how well the recovery goes from here is going to depend as much or more on healthcare policies in the United States as it depends on fiscal and monetary policy. Meaning fiscal and monetary policy will be important, and I think we still need more fiscal policy to extend unemployment benefits, although they likely need to be restructured to give incentives for people to go back to work. We need aid to state and local governments, but they're not going to be a substitute for basic things like people in the United States wearing masks and I mean broadly wearing masks. And that's not happening in the US. It's very uneven. Unlike what I hear about some European countries and certainly Asian countries where there's been much better compliance with wearing masks, I think there's been some confusion here, even mixed messages. And so what we're finding, for example, in the state of Texas, is mask wearing has been uneven. And mask wearing, testing, contact tracing, good hygiene, I will talk about those issues probably in every discussion I have, because at this point, they are likely the key to the critical path of how fast this recovery is going to go. And right now in the US, the jury is out in that we've had resurgence in a whole range of states. And to the extent that happens, and given the consumer is 70% of the US economy, we are going to see consumers here are going to be reluctant to re-engage in a broad range of activities, which will help bring back small businesses, the service sector, and other businesses. It won't happen to the extent it would have unless we really are disciplined here in our healthcare protocols. And as a central banker, that's not central banking policy, but I have to call it out because I don't want people to believe that more monetary policy is going to be a substitute for that. And put it differently, what I've said is I'd rather spend hundreds of millions of dollars or even billions of dollars on healthcare protocols so we can avoid spending trillions of dollars on more monetary and fiscal policy, which, as Jacob, you said, is not free. There's a cost to pay for these policies. So that's the challenge we're literally facing in the US right now. Now, there's 2 or 3 other challenges I'll very quickly mention. One is this pandemic has affected our population differently based on whether you're Black, Hispanic, and also skewing very much by levels of educational attainment and whether you were lower income going into this, and that those groups have been disproportionately negatively affected. And we see the Black and Hispanic unemployment rate has risen faster than the overall unemployment rate, even though it's elevated in general. And we see if you were lower income and lower levels of educational attainment, it is less likely that you can work remotely successfully, I think as one of your other speakers said. And instead, it's more like you've got to go into work, or to have a job, you've got to be interacting with customers and with people. And so those groups have been disproportionately affected. And this is a big challenge for us as we come out of this crisis. Second issue is going into the crisis, we talked a lot about the need for more early childhood literacy, better educational attainment, more emphasis on skills training in the United States to close the gap between less educated and more educated. We were making great progress going into this crisis. We're now going to have to redouble our efforts because we've taken a step back, and we need to refocus, doubly refocus on these structural reforms that are going to help big groups of our at-risk populations. And we will grow faster if we have a more inclusive economy, and we have a lot of work to do on that. We have a big issue, lastly, in this country on how many small businesses and service sector businesses make it through this crisis. And again, the jury is very much out on that. I think if we had good adherence to healthcare protocols and we were able to control the virus, I would be more optimistic. But I think these are structural issues. Again, monetary policy and to some extent targeted fiscal policy can play a role, probably targeted fiscal policy more than monetary policy. But these are big challenges we face in the United States, and how much permanent scarring is done and how much damage we have to deal with out of this crisis is going to depend on how well, how that unfolds. And so the fact of the matter is we have a number of issues that we're going to have to deal with, and what it means for the workforce is there's going to be a meaningful percentage of workers that do not have a job. The job they had may not be able to go back to. They may have to find new jobs, new industries. They may have to get retrained. And the trend of technology and technology-enabled disruption, which was accelerating pre-crisis, I think has dramatically accelerated as a result of this crisis. And I think it's going to change the structure of jobs, workforce, need for skill training, education, and I think we're going to have to manage that. And that's another challenge we're going to be dealing with. And we're already seeing it now coming out of the crisis. So let me stop there.
Thank you very much. Well, by now we have gotten such a plate full of ideas and challenges. So rather than engaging into a one-on-one communication with each panelist, I know there are so many participants that are experts and wish to raise questions. Let me try to put some of them together into some issues. And I want to remind you, you are free to put down more questions as you wish. As we look at this crisis, it is obvious that at the end of it, we will have more debt than what we started. As we look at the previous crisis, it is self-evident that at the end of it, we ended up having more debt than we started. And this is true for everyone who can issue debt, whether it's governments, whether it is households, whether it is corporates, etc. So the BIS now for quite a few years and many others have raised the concern about what happens to the financial system as we are having more and more debt. Is the current low interest rate giving us a kind of a misleading silence and quiet and sanguine, which may suddenly come to haunt us when that service may become even more expensive? These are several questions that were addressed during as I received some messages. The first one of whom was Bernard Snoy, and he was joined by others. So maybe I'll take this theme of debt. And of course, Klaas, you wear two hats in this regard, also the Financial Stability Board, and you have the Fed. I leave you the opportunity to each one of you to say whatever he wants. There are quite a few questions, so the length of your answer will determine how many more questions there are. So let me go in the same order as we started. Klaas.
Yeah, thank you, Jacob. This is what I think, in my opening remarks, I referred to as the ratcheting up of debt. That each time you go into a crisis, you start with a higher level than you did last time. And I think it is undisputed that if you enter into a crisis and when you are in a phase like this, that will almost have to go up. If not, public debt because of the fiscal impulse that is needed at this point in time, and private sector debt will simply go up for a variety of reasons, etc. But I think the key to this is actually the policy in the in-between years, and the lack of symmetry that we've seen thus far in terms of our pursuit of countercyclical policy. Fiscal policy, for instance, is now countercyclical, which is good, but it was probably not enough countercyclical in the more benign years in between. And in the more benign years, you would have expected governments to build the resilience that can then fully be used in years like the current one, and probably also the next one, and who knows how much longer. So it is more about, I would say, policy in the good years than policies during the crisis, because at this moment I think there is little choice. And secondly, as I already also mentioned, if you rely so heavily on monetary policy, well, you know that lowering rates, of course, is providing incentive for more private indebtedness. And then the idea that you can counter that with macroprudential policy, which is, I think, something that has gained ground after the global financial crisis. But that's an idea that is also still largely untested, because if we look back at the track record of macroprudential policy in the benign years, also that has not been all that well. When we went into this corona crisis, and for instance in the European Systemic Risk Board, we started talking about releasing macroprudential buffers like the countercyclical buffer in the banking sector. Well, that buffer had been activated only in a handful of countries, and many countries had not even started sort of building macroprudential resilience. So I mean, this is all too human, but nonetheless, if we want to improve policy frameworks here, there should be much more emphasis on the kinds of policies that are being conducted during the more benign years.
Thank you very much, and this connects a little bit with what Yves MERSCH indicated, that as we deal with the short term, we should have the long term in front of our eyes. Would you like to add anything to it in the context of that, Yves?
Yes, I would, in the same vein, say that there are a certain amount of pro-cyclical effects, not only in the fiscal frameworks, but also in our regulatory framework. And after the last crisis, we have been a little bit more successful in building up a certain amount of buffers in the financial system. The issue that we now have is, will the banks make use of these buffers? And this is part of a very interesting discussions that is ongoing, because we see that there is certain resistance to use the buffers, because there seems to be a collective action problem among the banks, that the one who uses the buffer first would acknowledge that it would have difficulties and be weak and would impede his access to the markets. So how to make the usage of these buffers when they are needed useful? And this is a discussion that is related to some restrictions to payouts that we have also taken in order to increase the available capital absorption inside the banks. So as we see, as the crisis unfolds, I think we should be very careful that we would not be hit by a financial amplification of the crisis this time around that would be hitting the real economy really bad. So that is the main approach of the supervisory reaction function that we have taken. We have, for example, taken out some pro-cyclical effects that were built in, for example, IFRS 9 rules. We have also in the NPL recognition tried to smoothen the effect, to have also tried to protect market making by introducing more through the cycle approaches in the banking system. So all of this time around has been recognized at a much earlier stage in order to avoid an amplification of the crisis by denying the crisis early on and then falling into extreme reverse. Whether this will be sufficient remains to be seen, and for me it is very important that this time around we will have a proper sequencing of what Klaas has called the proper policy time to play its role in order to prevent an acceleration of the crisis. Of course, as Robert has said, we will all be doomed if we would have an enormous second wave that is not predictable right now, because as long as we do not have widely available vaccine, I think we are all subject to a pandemic which we do not dominate and where we learn something new by the day. So all this being said, I think in Europe we are also for the moment well served by the higher amount of social networks that we have, which has also shielded the economy in a first stage. But how long are we able to continue to finance in this respect? So therefore it is enormously important that the sequencing of the response function is working well, and that the recovery is not exercising unknown structural effects on the demand and on the supply side that we do not recognize yet as now.
Thank you very much. In the meanwhile, I can only tell you that while the time that was allocated to us is given, I think that Mark Uzan, you should be aware that we have material from questions for the next 5 webinars, seminars like those. So I would like now to move on, but maybe we'll have a little bit shorter answers as we move on. But before, still I owe Rob KAPLAN.
Well, so given the shortage of time, let me try to do this in 1 minute then, and it just and get us moving on.
Yes.
Since the last crisis, the consumer actually in the last 12 years in the United States has deleveraged, not perfect, but much improved. The financial sector, particularly the banks, we've deleveraged. It's corporate sector, which has a record amount of debt, non-bank financials, non-financials, I should say, and the government. And unfortunately, we believed, and I believe even in this crisis, corporate debt has been an amplifier. And the amount of government debt may appear at times to be free, but I think unfortunately at some point we're going to have to reckon with that also. And so I'm concerned about both those, and there are factors in my thinking when I think about monetary policy going forward.
Thank you very much. And which brings me to another theme that connects several questions. The first one was put by Osman Mandant, but there were some others too who joined that theme, which is the following. We are all talking about a recovery phase, maybe even a slow recovery, but emphasizing also that some of the effects of that pandemic has been accelerating some maybe positive developments, like digitization, like working habits, like travel things that some of us have done too much and the like. So fast forward to the so-called new long-term equilibrium. And I will give you a very short time only to relate to this. Do you expect that when the recovery is complete, and we are already on the second side of that crisis, are we going to just recover, be below the equilibrium that we had before because of the permanent disruption and hysteresis effect, or maybe be above because some new avenues will be open to us that we cannot even foresee now? So that's really a question to your basic instincts of optimism, but I'm sure that you can articulate them. Why don't I go in this in a reverse order so that, Rob, because you were so brief on your previous answer, you have time in the bank. So
there'll be winners and losers as a result of the trends you talked about. Technology-enabled disruption, people working more from home, people realizing they don't need to travel as much. That will benefit particularly a number of companies that use technology that have very large platforms. The issue will be, and I think those trends are accelerating literally as we're sitting here right now. These changes are happening now. What the effect is, though, is those will make it more challenging for many small businesses, mid-sized businesses, service sector businesses, conventional businesses. They'll either go out of business, or they're going to have to dramatically restructure, or they're going to have to restructure with much fewer workers. And most companies I talk to, no matter the industry, are heavily investing in technology to replace people and become more efficient. And they have much less pricing power because of these trends. The challenge for us will be in the United States. I have no doubt, and I'm not worried about companies' ability to adapt to this. I am worried about the ability of the workforce to adapt to it, particularly if you have a high school education or less. We have 46 million workers in the United States out of 160 million workforce that have a high school education or less. That group, if you're highly educated, these technology trends may mean you're more productive, you make more money, and there might be some trauma, but you'll work through it. if you have lower levels of educational attainment, you're going to need to get retrained. You're more likely to see your job restructured or eliminated. And I think that's a big structural challenge we have here in the United States.
Thank you very much. There is another set of questions all deal with optimism and pessimism and things of that type. And the main theme here is, if we had this meeting 3 months ago, the subjects of challenges would be China in the US and Europe, trade situation, oil, maybe Saudi Arabia and Russia, debt. In other words, there was a long to-do list. These issues have not been solved. Superimposed on them is the crisis that we are now dealing with. So when the uncertainty about the pandemic is removed, and some of the good things may come, and good work habits, etc., still the other to-do list elements are there. Which brings me now to the question that was led before: are we going to be, at the end of the day, ahead of the game or not? In order to show, let me make this as a statement rather than a question. And I'm going to switch to another question that came from the audience, primarily to the European members. And one of them had to do by Marek Mora from the Czech National Bank. How do you assess the consequences of the ruling of the German Constitutional Court for the ECB monetary policy? Second, and related to the first remarks that I made, how can you be so optimistic about the EU in the longer term, given that there are so many structural issues that are still there? And this question is connected by some others. I will not repeat them, but I will ask, because I have a long list, and it will be okay for the agenda for the next webinar, but now, if you can, Klaas, if no more than 1 minute per this question, please. And I know you cannot do justice to it, please. Klaas.
Okay, Jacob, then in case of the two questions, I think Yves is the lawyer who is more knowledgeable about Bundesverfassungsgericht, etc. Let me say on this, the competitiveness and structural divergences within the euro area, I entirely agree that that needs to be part of the recovery agreement as well. Public investment is an important part of the puzzle, but reforms continue to be an equally important part of the puzzle. At the end of the day, if you end up with a union where you would have structurally weak and structurally strong regions, and structurally strong regions would continuously be called upon to support structurally weak regions, there are very little federal countries whom I know that are in that situation, which are quite happy with this situation. Both, I think, in Belgium and in Italy itself, you can see a lot of north-south tensions and rivalry emanating from that situation. So that means that even with this public investment impulse that I believe can be provided by the recovery fund, also there should be an expectation of a structural reform program that should bolster potential growth. Let's talk about Italy for a moment. 20 years, zero productivity growth. I mean, that's the real problem. The real problem about the indebtedness is the lack of earnings capacity, the lack of repayment capacity. So it's the combination, in my view, of public investment plus reforms on the ground that should sort of restart this convergence engine that European integration has always been and has been for a long time, since the late 1950s until, let's say, the millennium change. And let's take that as our main challenge, that we restart this convergence machine. And the two factors that I mentioned, I think, are both equally crucial in that respect.
Thank you very much, Klaas. Yves, if you can squeeze your answer for 1 minute, please.
Well, the German Constitutional Court does not affect monetary policy of the European Central Bank. For everyone who wants more details and explanations, I will have a panel next week with the former governor of the Austrian Central Bank, which is entirely dedicated to the subject. But that is the conclusion. No effect on ECB monetary policy. So that leaves me 40 seconds to say that where we see change needs to have a very clear view where we want to lead people, and where we believe we should lead. And that for me should be resumed in two words. One word is digital, and the second word is green. And those will be, for Europe at least, the two directions in which we will lead innovation and modernization. And I think these are two directions in which our populations are ready to follow. And for the central bank, that means that we also have to adjust to show how we are adjusting to these new targets of digital. And that is, for example, the case in payment systems. And we are actively also preparing in order to live up to the new environment that might come about through demand changes or behavioral changes in this respect. And also when it comes to what is our contribution to greening our economy.
Thank you very much. And you indirectly already answered another question by Osman Mandeng, who asked about exactly the role of the central bank digital currencies, which means that you will have few more people in the audience for your panel next week. Let me cross the ocean, because we were now focusing on European perspectives, and one of the issues is spillovers of ideas. And Rob, I know that you have been very vocal about your concern about either negative interest rates for the Fed or the thinking of yield curve control and things like that. And of course, when you go to Europe, you see that the negative interest rates is part of the bread and butter. I'm not sure that all governors like it so much, but it is part of the reality. So maybe you can say something about it, and this will bring us close to conclusion, please.
Well, the concern about negative interest rates for me has been weighing potential benefits against the fact we have a very sizable money market industry in this country. Many companies are heavily reliant on borrowing in the commercial paper market, or short-term funding market, based on a healthy money market industry. And my concern is that if you had negative rates, what would be the negative effects on financial intermediaries, including money market industry, commercial paper, banks in general, and are the benefits worth the cost? My own judgment is I don't think so. And I think this comes into the category of there are limits to monetary policy. There's fiscal policies, there's structural reforms, there's other things we need to do. Monetary policy needs to play a key role, but I want us to be careful about not trying to go too far in what we do as central bankers.
Thank you very much. I got a sign that we are exactly 60 minutes into our webinar, and I'm told that the success of a chairman is not the way he moderates, but the time that he ends the discussion. So I don't want to contaminate and destroy my reputation. So let me just conclude by thanking so much all the three panelists, Rob Kaplan, Yves MERSCH, Klaas Knot. You brought us a wealth of knowledge that showed first the unity of central banking. There is a lot in common, and yet there are some differences, and the differences reflect different perspectives, different institutional settings, different place in the cycle, and things of that type. The unique role of the pandemic in this particular crisis is indeed unique, because first it is the source of uncertainty about our forecast in the future, But second, it is also the source of the fact that we are where we are. We would not have had the lockdown and the consequent destruction of output and employment if it was not our correct effort to deal with the immediate impact of the pandemic. And yet, at the present time, we have basically three things that we can advocate as citizens, which has to do with masks, hygienic, and social distance. And this is as much as we can do before the scientists are coming in with the actual vaccine. We all speak about vaccine, and we have forecasts about the average time that it takes to bring a vaccine. I would like only to remind you that of the coronavirus family, we do not have yet a single vaccine. There were some coronaviruses attacks like the SARS and the like, and they disappeared by themselves, but it's not because of a successful vaccine. And therefore, I would be very careful in having false hopes, and we better adapt our economies, behavior, and manners, and everything else to live with the corona, and it is obviously possible. And one of the consequences of the corona crisis is that we can have seminars of this type that we are having now. We save a lot of energy, literal energy and human energy. We save a lot of time. We lose some interaction, especially even when we meet, we cannot touch each other, but it is very constructive, and we bring people from all over the world with a stroke of a computer. So I want to thank you all, but most importantly, thank Mark Uzan and Reinventing Bretton Woods, and the floor is back to you, Mark.
Thank you, Jacob. Thank you very much for moderating these very interesting sessions. I would like to thank all our speakers also for accepting our invitation to participate. Just to let you know that we will continue our series. Very soon we will welcome the Bank of Thailand to introduce their interesting project of central bank digital currencies. And after next, we used to organize every year a conference with the Central Bank of Peru in Cusco. We will not be able to meet in Cusco, but we'll be meeting digitally. And I think there will be a lot of interesting questions for the emerging market world. We see a new area of policymakers, of policy making in emerging markets. Thanks for all of you. We will keep you posted for activities, and looking forward to seeing you hopefully in person maybe next year or earlier. Thanks again. Thank you. Bye-bye.
Thank you.
Bye-bye. Bye-bye. Cool. Thanks.
Bye-bye.